Okay, now let's see how do we really calculate impairment loss. So remember, when there is an impairment indicator founded by the company, they have to check whether there is an actual impairment loss or not. For that, they have to follow an impairment testing as per the standard. Ready? So let's say, what is that testing? Ready? Remember, you have an asset, you have a PPE, or let's say a machinery or a building. So who's carrying amount? Carrying amount simply means current book value, right? Current book value, which is 10 lakh, just assume. And the recoverable amount of that asset that I'll discuss soon in detail, but now I just say how much amount you can recover from this asset. Ready? Just imagine that is 8 lakh. So remember, your carrying amount is more than recoverable amount. Then 2 lakh is the impairment loss. Ready? So then I'll say if carrying amount is more than recoverable amount, then there is an impairment loss. Otherwise, there is no impairment loss. That means if even after there is an impairment indicator and you made a checking and you found that your recoverable amount is more than carrying amount, let's say 11 lakh, then there is no impairment loss. And remember, there is no concept of value appreciation. Here we only discuss value reduction. Ready? That's it. So once your carrying amount is greater than recoverable amount, then that is called as impairment loss. Ready? So simply we can build a formula like impairment loss is equal to carrying amount minus recoverable amount, right? That's it. So now we have to see these two terms in detail. So first of all, what is carrying amount? Remember, carrying amount simply means current book value. Let's say you purchased an asset on 1/4/2010. So original cost means the cost of purchase, right? Initial cost, ready, which is 10 lakh, ready. But you make it impairment checking after 4 years. That means let's say 31st March 2014, right? So you have to deduct 4-year depreciation. 4-year depreciation. Remember, your total cost is 10 lakh minus scrap value is nil. Just assume scrap value is nil and total life is 10 years. Just imagine. So then one year depreciation will be 1 lakh. Then how much will be the 4-year depreciation? 4 lakh, right? So then current book value or let's say carrying amount on 31st March 2014 will be 6 lakh. So this is the way we calculate carrying amount. So carrying amount simply means original cost minus depreciation up to the date. That's it. Very simple. Or simply let's say current WDV. Ready? That's it. A value after the depreciation set. That's a simple data, right? That's it. We can from the books of accounts. Ready? Now let's see recoverable amount. This is more interesting. Remember, listen carefully. Recoverable amount literally say it's a higher out of two amounts. One is fair value less cost to sell. I shortly called fair value less cost to sell, shortly called FVLCTS, right? Or value in use. Remember, out of which is a higher amount, that will be called as recoverable amount. Let's get into detail, clarity. Listen. Remember, you have an asset. So the word recoverable itself gives you a meaning. Recoverable means the amount which you can take or recover either by usage or by selling it. Remember, you have an asset, you have a fixed asset. With that fixed asset, you have a choice. Either you have to sell it now, you are not using it anymore, you just sell it now. Or you have the second choice, we are not selling it now, we using for remaining useful life. These are two choices every businessman have with that fixed asset, right? So remember, if you take first choice, that means you want to sell it now. How much amount you will get? That is called as fair value less cost to sell. Let's see how do we calculate fair value less cost to sell in detail. Ready? Remember, fair value means estimated selling price. That is the clarity of fair value. This is the word we have to use in many standards. Ready? This information we need in many standards, and especially we have a special standard called INDAS 113 that we will discuss later. Fair value measurement, right? Remember. So fair value simply means estimated selling price. That means you have a vehicle, you have a car. How much you will get when you sell it now? That is called as estimated selling price. But that, let's say that is 10 lakh. But remember, when you sell it, you might have some cost, like you want to pay some brokerage for the brokers, or let's say you want to pay some commissions to salesmen, right? So this kind of selling cost you might have, that you have to deduct. Let's say 10% is the selling cost. So how much is the net selling price? Net selling price 9 lakh. This net selling price is officially called as fair value minus cost to sell, right? That's it. So this word itself gives you the meaning of FELCTS, right? That's it. Okay, so remember, tell me, how do we get fair value less cost to sell? Estimated selling price minus estimated selling cost. Ready? Sir, we are okay with your theoretical clarity, but we have to have a confusion. When we work practically, how do we get this data? Remember, let's have a practical clarity on this one. How practically a company takes this fair value, from where they get this information? This is the practical clarity you must have. Is it a guesswork? Absolutely no. It should not be any guess amount. If it is a guess amount, how your stakeholders can rely your financials? No. It should be with a proper authenticated information. That is usually get by two ways. Either by market information. That means market information means a price which is openly available in the market. Let's say when you calculate a fair value of shares, especially shares of a listed company, you can take a listed market price as a reasonable source of fair value, right? That is openly available. Ready? As of now, if you want to know the Reliance share price, then you can easily just Google it, then you can take that information. Ready? Closing price of that concerned date. And just like that, if you want a fair value of vehicles or gadgets, ready, you can take a platform price like a price from OLX or some other platform which gives a reasonable market price as on the prevailing date. Ready? So you can take this kind of market information as a fair value. Ready? But remember, if we have an asset like land and building, plant and machinery, furnitures and fittings. So for this kind of assets, there's no kind of market information is not available. Then what we'll do? Then the company will take a valuation report, a valuation certificate from the authenticated registered valuers. They are the separate professionals. Registered valuers. So they are the separate professionals under registered values organization. So after you being CMA or CACS and with 3-year experience, then you can apply for this registered valuers. And also they have some modules and small exam. After you clearing, you can also be a registered valuers. Then once you become the registered values, you are officially recognized to give this kind of valuation report. So companies at the end of each year, they take a valuation report from this registered values, and in that valuation report, this values give a value for that concerned property or land and building. Ready? Land and building, plant and machinery. So let's have a sample check for this property valuation. Let's have a small practical insight, not for the exam clarity. Remember, there's a sample copy of a valuation report of a independent house. Ready? A land along with a building. Ready? So in that valuation certificate, they give all the basic information. I'm not checking it. So coming into this valuation figures, remember, they take this kind of a value. Ready? Yeah, that's it. It's a value of land along with value of building. They have a guideline value, that means the fair value, and then the fair market value. This value is a value listed by the concerned state governments based on the survey number, right? But this is usual market price in the concerned region. Ready? So they have these registered values have their own statistics and modules for guidelines for fixing this kind of price. I'm not coming into that kind of details. I'm just showing how they setting some prices. Ready? So then they will give you a total value of that property. So that what the company do, company will trust this valuation report. Ready? That's it. That is the way really a fair value or information gets by the company. Ready? That's it. So for this valuation report, the company have to give a valuation fee. Ready? That's it. In short, fair value less cost to sell simply means estimated selling price minus estimated selling cost. Ready? So what in short? Estimated selling price is not a guesswork. This is an authenticated information which we derive like this. Ready? I think you're perfectly okay. Ready? Now a recoverable amount is a higher amount of fair value less cost to sell. Out of that, now we have to see value in use. Remember, as I said, value in use means if you take the second choice, that means you are not selling it now. You want to continue using for the remaining life. Then how much net cash flow you can take? That is called as value in use. Let's say an example. Remember, let's have a sample check. How do we really calculate a value in use? For that, I take a base example. A machinery which is solely used for, which is solely used for production. Okay, let's see a basic calculation. Remember, we have a machinery which is used for production. Ready? So on the date of checking, we have a remaining useful life for 5 years. That means you can use this asset for remaining 5 years. That is the estimated remaining life. And every year this machine produces 1,000 units. Just imagine, every year this machine will give you 1,000 unit of outputs. So this 1 unit of output you can sell at a price 200, and it has a cost price of 120. So remember, so for every one product you get a net cash flow of 80 rupee, right? Net cash flow of 80 rupee. Ready? Just a minute. 80 rupee. Ready? That's it. And for every year we get a total 1,000 into 80,000 net cash flows. Ready? So then remember, for every year we take 80,000 net cash inflow from this production. So what is the net benefit every year this machine gives you? 80,000 into 5 years. We are not taking any growth or decline. We just go with basic calculation. We are not projecting with growth rate. We take a simple example for the sake of business. Ready? So in that case, remember, every year I'll get an 80,000 as I calculated. 80,000 is a net cash inflow like this. Ready? Total inflow 200 into 1000, 2 lakh minus 120 into 1000, 1 lakh 20. So 80. So 80 for 5 years. Ready? But remember, this is future values. This is future values. That means this 80,000 you will get after year 1, after year 2, year 3, 2. But remember, we want the value as of now. For that, you have to convert this into present value. By using the FM concept, we have to convert back into present value. For that, we need a present value factor by using a discount rate. Ready? Remember, we take a 10% basic example for discount rate. So you take your calculators, and calculate how present value factor will be. Ready? So you can calculate either by 1 divided by 1.1, or let's say 1.1 divided by and equal to. Ready? You can calculate present value. So remember, every year you get this present value factor, or we can easily calculate, instead of each year present value factor multiplication, since it's a equal amount, we can simply calculate the present value like this. Just a minute. Yeah. Years 1 to 5, cash flow is 80,000, and cumulative present value factor at the rate 10%. Ready? A dash amount, and when you multiply that cumulative present value factor, you know how do we get cumulative present value? You calculate each year's present value factor, and then you take a grand total, GT. Ready? That's it. So then we will get a present value. Then this is called as value news. But wait, we have an editing. Remember, we take a net cash flow from usage in every year. Ready? So as of now, we said value news is equal to present value of cash flows for the remaining life. But along with this amount, we have to add a terminal cash flow, or let's say estimated residual value. After 5 years, you will have a scrap value which you can get when you sell it into the market. So remember, so let's say that is 50,000. Ready? So 50,000 into 50 year present value factor, and then you will get a dash amount, and that amount will also be included in this. Then the total of present value of cash flow from continuous usage and residual value, or terminal cash flow. You know this concept in your SFM or FM, right? So that total will be value news. I think now you got a correct clarity how we really calculate value news. So in short, value in use simply means present value of future cash flows from usage and scrap value, right? Let's say another example. You have a building which is solely used for renting. You have a building which you use for renting purpose. So how you will get the benefit? You will get the benefit in the form of rent income. Ready? So remember, you have a building which have a remaining life of 5 years. Ready? Every year you have an annual rent income of 1 lakh, but you have a maintenance expense for 10,000. Remember, every year you get a 90,000 net cash flow. And this you will get for 5 years, and you multiply with a present value factor, then you will get a present value cash flows along with a terminal cash flow. Ready? So this is the easy way we get the value news. So in short, present value of expected future cash flow from continuous use and residual value is called as value news. And so then if that is the case, in short, recoverable amount is the higher of fair value less cost to sell or value in use. So fair value less cost to sell is equal to expected selling price minus expected selling cost, and value in use is equal to present value of future cash flow from continuous use and residual value. Okay, right. So how do we calculate impairment loss? Remember, you have a carrying amount 10 lakh, and now we have to calculate recoverable amount, which is a higher amount out of fair value less cost to sell. Just say that is 8 lakh, and value in use is equal to 7 lakh. Just imagine. So how much is the recoverable amount? Out of which is a higher amount, 8 lakh. Remember, sir, we have a confusion. Why we take higher? Why we are not taking lower amount? Remember, being a strategic businessman, they will take a best choice. If you sell it, you will get 8 lakh. If you use it, you will get 7 lakh. Which is the best choice? Sell it. And if this is 9 lakh, instead of selling it, you will take a choice of using it. Ready? So every businessman will go with the best choice. So based on that concept, we take higher amount as a recoverable amount. Ready? So if that is the case, we will have a impairment loss of 2 lakhs. So then on that date, we will pass an entry. So how now we have to see what will be the basic entry for impairment. Basic entry for impairment loss. Ready? Remember, you know the impairment depreciation entry. Remember, you know the depreciation entry, depreciation account debit to asset account, and every year this depreciation will be transferred to P&L account, and then we will have a transfer entry. So instead of this two entry, we can sum up into, let's say, this and this you can vanish, and then basically this will be the entry, P&L account to asset account. So instead of we saying two entry, we shortly say this P&L to asset account. The same entry we will also follow for impairment loss, because here also we have a loss and we have a value reduction for the asset. So loss we take to P&L and the asset will be reduced, right? So from this discussion, we discussed all this basic discussion relating to standard. Now you can take my material, everything I'm written there. Ready? So first of all, what is impairment loss? Ready? It's a loss in value of asset. Loss in value of asset due to any reasons other than depreciation. Starting discussion, maybe I say fixed asset, but we cannot say a fixed asset, we say asset. So this asset means the applicability of this standard means fixed asset including investment. Fixed asset means tangible asset and intangible asset. Alongside this, impairment guidelines will also be followed for investment, but it is not applicable for current assets like stock or debtors because it has a separate standard. Ready? So in short, this standard is applicable for fixed asset, that means tangible and intangible, alongside financial assets like investment. Ready? That's it. Now, what is the core difference between depreciation and impairment? Depreciation is a systematic reduction, that means regular reduction, but this is irregular and unsystematic. Ready? Now, what is the difference between downward revaluation and impairment? This we'll see after INDAS 16 PP, then only you will have a connection. Ready? So let it be pending now. Ready? Now we list out indicators of impairment. Ready? External indicators, abnormal decrease in market value, adverse effect of market economy, but this was a pending item. Now we can discuss that. Ready? Now we can discuss increase in interest rate. Whenever there is an increase in interest rate, there is a high chance for impairment loss. How this increase in interest rate lead to impairment loss? Let's see. Remember, during this current year, RBI increased the repo rates, bank rates. You know this one. Ready? So based on this bank rates, the present value discount rate will also change. We take this present value discount rate as an either incremental borrowing rate, ready. But remember, so during this current year, just imagine the interest rate gone up by 2%. So let's say instead of discount rate 10%, then in such situation we have to take a discount rate of 12%. So if that is the case, of course, you for the sake of easiness, this 80,000 is multiplied with 10% present value 0.909 into 80,000. You will get 720. But if interest rate is increased, and by the way the discount rate is also increased, let's say if you calculate the present value with 12% discount rate, then present value will be ready 0.892, and if you multiply this with 80,000, you will get nearly 71,428, right? So that means what? When the interest rate gone up, by that way discount rate gone up, value in use will be reduced. Value in use will be reduced. If value in use is reduced, there is a high chance that recoverable amount will also be reduced. Remember, recoverable amount is equal to higher of fair value less cost to sell, ready, or a value in use, ready, value in use. Remember, fair value less cost to sell is 6 lakh, and value in use, if interest rate is 10%, just imagine value in use is 7 lakh. If interest rate is 12%, just imagine, I'm just say notional amount. Of course, if rate is gone up, then value in use will got reduced, ready, 6.8 lakh. Just imagine, in that case recoverable amount will be decreased. 6.8 will be the recoverable amount, and if carrying amount is 8 lakh, then in that case you will have a 1.2 impairment loss. If interest rate is 10%, then it will be 7 lakh, and impairment loss is only 1 lakh. So in short, due to this increase in interest rate, there is a chance for impairment. I'm not saying in each case there will be an impairment loss, but there is a high chance. This is just an indicator, ready. So then internal indicators we mention here, ready. Then how do we calculate impairment loss? This is the basic checking, and we give entire data, ready, carrying amount, recoverable amount, ready. So recoverable amount is a higher of fair value or value in use. This fair value is equal to this, and value in use is equal to this. I'm not saying it, and again, and the basic treatment generally we take into P&L. So that is the discussion we made, ready. So now we have to do a question 1, ready, in our material, ready. So that I'll do in the next video. Bye bye. Ready. So I think everybody's okay with this basic discussion. So in this discussion we discussed what is impairment, clearly we discussed, and we discuss how do we calculate impairment loss. I'm not just say and go, no, I try to convince all the points practically, ready. That's it. Now we have to go to questions in the next video. That's it. Bye bye.